This is the study session on financial reporting and analysis and the reading on understanding income statements. Now remember, in the first two readings, they were kind of big picture items. And I warned you that as we go through the readings, we're going to have to be more specific and pay more attention to the details. So that's what we're going to start with in this reading on income statements. What we're going to do is start at the very top, P times Q, which is the revenue, and we're going to work our way all the way to the bottom, and we're going to call that net income. So let's pay attention to the details from the top to the bottom of the income statement. First LOS is a simple one, asks us to describe and actually define an income statement. So an income statement provides information on the financial performance of a company over a specified period of time. Remember, in the previous reading, I suggested to you that a balance sheet was like taking a picture of a company at any given time, but an income statement is like taking a movie of a company over time. All right, so under both the international standards and the US standards, the income statement may be presented as either a separate statement followed by comprehensive income or a single statement of comprehensive income. And the international financial reporting standards also require that there are things like line items and headings and subtotals and all that good stuff to help explain exactly what's going on. Notable components, of course, revenues minus expenses. This is the big thing on the income statement. What's the goal of the business? Remember from our capital budgeting discussions, always maximize shareholder wealth. And we've learned that firms can do this a variety of ways, one of which is to make something for pennies and sell it for dollars. And so revenues minus expenses, that's called some kind of operating income. Accountants tend to like to call it gross profit, and then we take out some other kinds of cost of goods sold, and we call that operating profit, and then we take out some other stuff and we call it net profit, although accountants like to call it net income. Here's a nice picture of Nike's consolidated statements of income for years 2015 through 2017. Notice revenues of 34, cost of sales of 19. That gives them a gross profit of 15. And then I really like Nike's creativity. Look here, they have demand creation expense and operating overhead expense. That sounds an awful lot to me like variable expenses and fixed expenses, although we have fancy names for this stuff. And then net income at the bottom, 4240, so that's millions of dollars. So in 2017, Nike generated a net income in excess of $4 billion. All right, how about one of these long LOSs? Describe general principles, revenue recognition, and accrual accounting, and then a bunch of other stuff that relates to those two things. Remember, accrual accounting is kind of an accounting policy that recognizes that cash doesn't really drive economic changes in a company. I mean, of course it does, but there are other things like selling on credit, revenue recognition. There are some rules about that as well. We'll discuss those in the next couple of slides. So when should revenue be recognized? The international standards suggest that revenue is recognized when there's a transfer of ownership and those risks have been transferred, no control over the good, revenue can be measured reliably, economic benefits will probably be realized. The GAAP guidelines are just a little bit more vague. Revenue is recognized when it is realized or realizable and earned. And so there's evidence of trade and that a product or service has been delivered. How about special cases of revenue recognition? I mean, it's one thing, going back to my example of working in the donut factory during my college years, it's one thing when a donut factory sells a donut at their retail store. I mean, clearly you hand over the donut and you get $1 or whatever it is. So that's a good revenue recognition. But there are some complicating factors out there. What happens when there are things like long-term contracts or installment sales when the cash or the promise to pay cash doesn't exactly match up with the timing of, when the expenses were incurred or when the revenues were actually realized? And so for a contract spanning several years, companies are allowed to recognize revenue in stages using the percentage of completion method. What about installment sales? If I'm a manufacturer of air conditioners, and these massive air conditioners for malls and colleges and airports, and I sell $20 million worth of air conditioners to an airport, and I go and install them, and I say, you know what, you don't have to pay me all today. Maybe you could just use your credit card or pay me on installment. And so the airport agrees to pay me in installments. Maybe they'll chop it up into 4 quarterly payments or over 2 years, or whatever it could be, whatever the terms of the trade are. And then of course I'm not going to let them do this for free. I'm going to charge them an interest rate. So we need to separate sales price and the interest component for installment sales. What about barter transactions? Of course, I'm guessing you guys know a little bit about history. If you go way back into the old days, I always imagined there were 2 farms and 2 farmers. One farmer raised chickens and another farmer grew wheat. And so these 2 families looked at each other and said, hey, let's trade chickens for wheat. And so there was an exchange rate between chickens and wheat. Of course, in the old days, there were no accounting bodies to keep track of this stuff. And over the years, banks and central banks started issuing money and coins. And so that most transactions are not barter transactions. But it's amazing how much bartering continues to go on today. So, of course, FASB, which has been around since 1973, they're interested in, trying to determine what is really revenue and what is really an expense. Let me give you a couple of quick examples. Service industry, like a restaurant, the margins in the restaurant industry are not large. And so restaurants are always looking to cut back on their cash expenses. And so restaurants will regularly trade their food services for things like maybe carpet cleaning or window cleaning or purchasing a new oven. And they'll say, hey, we need a new pizza oven. And what we'll do instead of paying you cash is that we'll provide your business with lunches for the next 2 weeks or whatever the arrangement is. So think about this. How is this recognized as a revenue on one hand and an expense on the other hand? But today, bartering goes on, for the most part, in the publishing industry. And so you have these publishers of things like magazines and newspapers. Does anybody ever read newspapers anymore? I do. I read the Wall Street Journal every day, and you should too. Or internet sites or web pages. And so what they do is they barter ad space. I'll give you space on my web page if you give me space on your web page. And so this advertising goes back and forth where there's maybe little or no cash trading hands. So this is lots of bartering going on these days. And so what are the rules? Under the international standards, revenue from barter transactions must be measured based on fair value. Based on similar non-barter transactions. So going back to the restaurant example, if the cleaning company charges $1,000 to clean the carpets, or the oven costs, I don't even know what a pizza oven would cost, $1,000. Whatever it is. And so it's kind of, if you can keep track of what those non-barter transaction monetary value is, that's what you record the revenue as. Under GAAP, can only be recognized if there is a historical value of similar trades. How about gross versus net reporting? So, clearly you have P times Q, so you have all those revenues at the top of the income statement. But then we're going to subtract out the cost of those goods sold. And a lot of times it's just easier to report net revenues or net sales. And so GAAP gives us guidelines about when to require gross reporting. Let's take an example of, let's suppose I'm a construction company and I agree to build an airport. And so I sign a contract today and I agree to build an airport. And those of you who fly regularly know that airport construction goes on for a really, really long time. And so I'm building this building, maybe a parking garage, and it's going to take me a couple of years. And then when I'm done it, then I'll get paid fully, and then my contract will be gone. So gross reporting, what does that sound like? Primary, obligor, yeah, that makes sense. Bears credit and investment risk, yep. Can choose the supplier, latitude to establish prices. And so that makes sense that should be gross reporting. Now, remember, let me go back here and say one quick thing. Remember, we talked about this in those previous 2 videos on the first 2 readings here, that what we're trying to do is make certain that the financial reports are transparent and consistent and accurate so that we as financial analysts can make a judgment on valuation. And so bartering and net reporting, we need to know the rules so that we can go back and look at those financial statements and make an accurate judgment and a reasonable judgment based on that information that has been provided to us. All right, how about revenue recognition and the financial implications? So let's think about this. If companies will make decisions that tend to recognize revenue a little bit earlier or a little bit later, or if the company has to make some estimates based on paying a little bit earlier or paying a little bit later, that has implications for the bottom of the income statement. And so there are 2 issues here. If a policy results in revenue recognition sooner rather than later, we call that being less conservative. And if there are lots of estimates, we call that less conservative as well. So make sure that when you're comparing 2 companies, it's so easy just to look at 2 companies and try to decide which one you want to recommend. It's so easy just to look at like a price earnings ratio and make a quick heuristic decision, but that's not the way financial analysis ought to work. Remember all that stuff that we talked about back in the ethics section is that not only do you have to evaluate these 2 companies individually, but you need to compare them and you need to know what their revenue recognition policies are. All right, what happens to revenue when we have a choice? So percent of completion method means that we're gonna recognize revenue when we complete a certain percentage of the contract or the transaction, and so we might do it in stages, like 1/3 and 2/3 and then 3/3. Or if we really don't know if we're getting paid or when we're getting paid or what we're getting paid, then we've got to do the completed contract method, which means we don't recognize it until the end. Which, of course, companies really don't want to wait until the end to recognize revenues because they're incurring all of these expenses during the project, like building a parking garage in the airport. Here's a good example. We have a contract to build a machine for $5 million. It's going to take 3 years, and we expect costs to be $3 million. Now, note that's $3 million, and those are estimates, so we don't quite know if it's going to be $2.7 million or $3.3 million. So we'll use the percent complete method, and at the end of year 1, we've spent $1 million. How much revenue should we recognize? And so all we do is take the $1 million divided by the $3 million of our estimated costs, and that gives us 1/3 times that 1/3 by the 5 million. And so we have revenues of 167 and expenses of 1. So we've got some kind of profit at 0.67 million. All right, how about some principles of expense recognition and some applications? So here's this big old principles-based stuff. We want to do some matching here. We want to match the revenues with the expenses. And so if I have the bulldozer and the bulldozer is pushing away the dirt, and I have the gas going into the bulldozer that's pushing away the dirt, well then clearly that gas matches up with the revenue generated by the bulldozer. Now, of course, we're going to have doubtful accounts. Sooner or later, as this construction company, we're going to buy gasoline, we're going to buy oil, we're going to lease shovels, we're going to do a whole bunch of stuff, and somebody's not going to pay us. And so we need to make an allowance for doubtful accounts. And then if we put a warranty on this, we've got to make an allowance for the warranty of future expenses. Maybe with the construction example, we'll have a warranty that says, oh, by the way, if that wall falls down in the next 5 years, we'll come back and fix it. How about non-recurring items? So discontinued operations or unusual or frequent items. This is going to fall This is going to fall under the separate heading of non-recurring items. And of course, this goes by the way of transparency. When a company sells an asset, remember years ago, Procter & Gamble sold its Jiffy peanut butter product line. So they decided they had to report that as a non-recurring item because it's not part of operations, and that should make sense. How about when we change accounting policies? The goal is to do this retrospectively. And so we go back and then we redo all of our old financial statements and we put together our current financial statements as if the policy change has always been implemented. I remember back in my undergraduate accounting days as an accounting major having to go back and restate the financial statements. And I do remember not liking doing that. What about operating and non-operating components of the income statement? Operating income is the activity that is generated by the assets of the business, the core part of the business, like building this building. You guys have been paying attention to my videos know that I always like to give miniature golf course examples because I'm fascinated with these miniature golf courses at the beach. There's so many of them. But you go to a miniature golf course and boy, do you have to pay for parking? Do they have a vending machine? Do they sell ice cream on the side? And so non-operating income are those revenues and costs that are outside of the core business. I'm not really sure which one is operating and not operating for the miniature golf course, but you get the sense that companies have other things that they do, and maybe other things that they want to do that would produce non-operating income. And here's a good example, Atlanta Oil. Notice we start with sales at the top of 350 and down at the bottom we have net income of 95. So somewhere in there we had a bunch of expenses, and they include things like cost of goods sold and all of our operating expenses, including depreciation. But then we have non-operating revenues and expenses, and so a lot of times this is interest related, and sometimes they're gain related. So that's just $1,000 out of the 350 in total sales. So it sounds an awful lot like this is a minor part of our business. You wouldn't call that the core function of the business here. All right, how about earnings per share? As financial analysts and as consumers of financial information, if you watch television or read the Wall Street Journal, you'll find that EPS, everybody talks about earnings per share. So this is really important. What it does, go back here, if we take that net income and divide by the number of outstanding shares, kind of a general formula, we get the earnings that are available to the shareholders. And remember, when you become a shareholder, you have a claim on the earnings stream of the business. Claim on the earnings stream. You don't have a claim on the assets. You don't have a claim on the product lines. You have a claim on the earnings stream generated by those assets and those product lines. So the question then becomes, how do we compute earnings per share? And it's not quite as simple as just taking 95 divided by the number of outstanding shares in this example back here, but it can be. If a company has a simple capital structure, what that means is that it doesn't have any securities that have what we call embedded options, like a convertible bond. So if it has a simple capital structure, all we really need to do is take net income and subtract out the preferred dividends, because remember, the preferred dividends get paid to the preferred shareholders before there are any common dividends that can be paid to the common shareholders. So we really want, let me go back to this, we really want that net income of 95 to reflect the income available to the common shareholder. So we take out the preferred dividends, and keep in mind that most companies don't have preferred stock outstanding. But those that do, they need to subtract out those preferred dividends. And then we divide not just by the number of shares that are outstanding on this particular day of the income statement, but we do a weighted average. So we take what we had last year, what we have this year, and divide by 2. Now, what happens if there is a complex capital structure? So let's take a look at just 3 quick examples here. So if there is an issue of preferred stock that allows conversion to preferred shares, you own the preferred stock, and you can convert those to common shares at any time. That new earnings per share, and by the way, we're calling this diluted because it's really potential dilution, not really this has already happened. It's potential dilution. And so we divide, so we don't take out the preferred dividends because we're assuming those preferred shares are converted to common shares. And we divide by the weighted average, same thing we did before, plus we have to add in the denominator any of those new common shares that are issued to the preferred shareholders at conversion. All right, how about if a company has convertible debt? So you buy a bond and you get the coupon payments, but at any time, maybe there's a deferred time period there, at any time you can convert those convertible bonds over into common shares. And so, of course, this is going to affect the denominator, but it also affects the numerator in that we start with the net income. We've got to take out the preferred dividends like we did, let me see back here, like we did back in the basic EPS. But then we have to add in the after-tax interest on the convertible debt because that reflects the interest expense on that convertible debt. And remember that we are allowed to deduct that on the income statement, so we have to do the after-tax thing because we get a subsidy. And then we divide by, of course, once again, the weighted average number of shares, but then the number of shares, we have to add the number of shares that the bondholders will receive when they convert their bonds. And how about when we issue stock options for executives? And so what can those executives do? They can issue they can convert their options. Now, a lot of times these stock options have a period under which the executives are not allowed to exercise those. But after that period is done, then we have to worry about those executives exchanging their options for more shares. So we take out preferred dividends in the numerator, if there are any, and we have to divide by a bunch of different stuff. So we have, once again, the weighted average number of shares outstanding plus those new shares that the executives are going to receive when they exercise the option, minus the shares that would have been purchased with the cash received upon the exercise. Because remember, the executives, they have to pay to buy those shares if the exercise price is 50 and the stock price is 100. So then the executives pay $50. So we're receiving that cash. And then we have to weight it during the course of the year. And there's a good example of the Nike consolidated statements of income. So look at the bottom there. There's the basic EPS, which is required to report. So this is if none of this stuff happens, right? None of that stuff there and none of the stuff at the top happens. And then the fully diluted ones, what does that number read? 251. So there's a 5-cent difference in the Nike income statement on EPS. All right, so we've been talking about these dilutive securities, so I shouldn't need to repeat what we've just talked about. And so what's happening here is that because there's an increase in the number of outstanding shares in the denominator, right? So let me go back to those formulas. There we have increase, there we have increase in the number of outstanding shares in the denominator. These dilute, they reduce or decrease the earnings per share. Anti-dilutive securities are kind of just the opposite. And these are securities that will result in an increase in the earnings per share after that security. And really the most common example of this is when a firm takes over a target firm and they issue shares of stock. They issue shares of stock, transfer those to the target shareholders, and then when they recompute their income statement, the combined income statement, the earnings per share goes up. And so a share of stock can be anti-dilutive if it's used in a merger transaction and the EPS goes up. How about common size income statements? And what this does is allow us to make a comparison of one company against another in terms of their revenues and their expenses. And so this is relatively straightforward. I have an example here, but first let's do a financial ratio of net profit margin, where we just take net income divided by revenue. And so what do we want as financial analysts if we're looking for firms that we might want to recommend or invest in of course we want lots of net profit margin. We want to generate 20 and 30 cents for every dollar in revenue. That's part of the making something for pennies and selling it for dollars. Gross profit margin, of course, is just gross profit over revenues. So here's a good example here. If we've got income statements for 2 years, and what we do is we translate them into a common size income statement. So revenues at the top are always going to be 100%, and then we just do the division all the way down to the bottom, and then we get the 44% for 2017. So what we can do is say net income is 44% of revenue. Wow, and we can make a comparison against another company that we're trying to evaluate and do some relative value analysis. Notice how much this adds to this common size income statement is important, because it adds value to our comparison between and among companies, much more so than maybe just a price earnings ratio or a price to sales ratio. I mean, those are really important, but what we need to do is, I'm a big picture guy, and we need to look at the entire picture. So here's Nike's comprehensive income. We start with that net income of $42.40. We had that on the previous slide a few minutes ago, and then we're going to make some changes to it. Foreign currency, gains or losses on hedges, and then some other gains or losses. And by the way, when we have a really, really fascinating discussion on derivative securities, we're going to talk about corporations and how they use forward and futures and option contracts to hedge. And then when that hedge goes in their direction, they get to report a gain on hedging. And what goes against their direction, they have to report a loss. And so they have to explain it to shareholders. They say, hey, look, we did the right thing. We just happened to lose. Total comprehensive income, as defined by the International Board, change in equity during a period resulting from transactions and other events. That's important. GAAP says comprehensive income is the change in equity. And notice in parentheses, we have net assets during a period from transactions and other events and circumstances from non-owner sources. So remember the difference between those two. Just a slight difference. All right, how about the part of the LOS that asks us to calculate? I'm always in favor of getting out our calculator. So we have beginning shareholders' equity of 500, net income of 50. So we're transferring that back into our net income, into our equity, right? So 500 plus 50, that gives us 550, right? And then we pay out dividends of 5, so we're down to 545. If our actual ending equity is 570, what is its comprehensive income? And so that's got to be the difference, right? 25, right? 575 minus 545, that's 20. And so, yeah, that's what we're going to do. We're going to take the net income plus our other comprehensive income. There's the 25 that we calculated. I did that pretty quickly. And that gives us 75. And here are the 4 types of item that both the international and the U.S. bodies treat as other comprehensive income. Foreign currency, there's the derivatives, there's the available for sale, and then there's retirement stuff. And that takes us through income statement. Lots and lots of good details. Just a few calculate, but a lot of describe, a lot of discuss. And we'll see the same thing when we do balance sheets in the next reading.